We received quite a significant amount of special dividend income during the half. $15 million of that was the participation in the BHP off-market buyback, as well as the unfranked dividend demerger from Wesfarmers from the coal shares. So income from operating activities was up 14%. Our net operating result was up 12%. As we always break out, that's the most important line in our result. That's normalised earnings for us. The next line you'll see there, EPS down 4%. That's a reflection of the extra shares on issue after our capital raise in June 2018, where we raised $150 million. Interim dividend, directors have declared the same dividend as this time last year, but I'll talk a bit further to this, but pleasingly we've also announced a 1.5 cent fully franked special dividend, and it's the intention of the board to pay a further 1 cent special dividend on or before the full year result in July. So total dividends for the half is 5.12 cents per share. I just want to highlight the current grossed up dividend yield. Those people looking for income, clients looking for income, 8.2% grossed up is pretty attractive, and that's excluding the further special dividend that we intend to pay out as well. During the half, we've reached 15-year milestone at BKI. Something we're all very proud of, but just some highlights there. We've got over 17,000 shareholders now, $1.1 billion of assets with a strong dividend history, strong dividend yield, significant proof of capital management. This is our 6th special dividend we've paid to shareholders. We've paid out over 97 cents a share in dividends over time, which equates to about $600 million. So, from a market cap of just over $1 billion to pay out that much is quite impressive, we think. We've got some good research and ratings from Lonsec, IRR, Morningstar and 360. Long-term returns are good, and we've got a pretty stable portfolio in current environments. Quickly, just to show you where the dividends and our income came from, driven by higher dividends from New Hope, AGL, Woodside, BHP, Sydney Airport, Macquarie, Transurban and APA Group. And as I said, we got a lot of special dividends this half. BHP buyback, $15 million, Wesfarmers demerger dividend, Telstra Cube, IAG, Suncorp and Woolworths. And we've already received another $2 million from BHP in January from their further special dividends. Just on slide 7 now, just to show you I suppose the impact of this ridiculous proposal to eliminate cash refunds from the Labor government, who are unfortunately probably going to get into power. The board's been proactive here, and we've tried to get rid of a few of these franking credits we've got. We've got $16.75 million of excess franking credits on the balance sheet, and that's why the intention is there to pay another 1 cent special dividend going forward. Slide 9 now. The ex-dividend dates for those 2 dividends is Friday the 8th of February. And I think, something we'd like to highlight is I think clients in growth and accumulation phase, we do have a DRP, great opportunity to reinvest that money for future growth and future dividends from the company. Of our performance, shareholder returns hasn't been great for the rolling year. 2% of that 5% underperformance came from CSL, 50 basis points from being underweight BHP and Rio, and we're overweight NAB and the banks, Invacare, Ramsay and TPG, which had a bit of an impact on our performance. But you can't have everything. You can't have great performance and pay out 8.5% grossed up dividend yield. So we've got our shareholders' best interest at mind, and dividends is first and foremost at the front of our mindset. Looking ahead a little bit now, dealing with the noise in the market. There's a lot of things happening in the market at the moment. Interest rates, change of government possibly, house price falling on the east coast of Australia, tighter credit conditions, high levels of personal debt, US-China trade war. China growth is coming off a little bit, and you got royal commissions in the banks and probably the healthcare sector as well. So there's a lot to look through. We're trying to block out the noise, and I think if you then look at slide 17 and have a look at the investment cycle, there's no question that we've probably rolled off the top of the cycle there, with falling share prices being probably the last straw. But I think the question we're asking ourselves is how far it's going to be before equities come back, and there's a lot of things to like about the equity market, we think, for the next 12 months. And strong global demand for commodities is still there. There's some supply constraints in a lot of these commodities which will bridge that gap. Got significant population growth, both here in Australia and offshore. Significant infrastructure spending still happening in Australia. We're going to have a very competitive banking industry going forward, where all they'll do is basically lend and take deposits from their customers. So we think they'll be very well placed going forward once the Royal Commission dust settles. The superannuation cash flows into our market will continue to be significant. And the levels of debt that everyone has got is one thing, but the cash that a lot of these investors hold as well is very positive. And we think that'll find a home naturally into the Australian share market. So we're sort of cautious on the macro side of things, but also very bullish on Australian equities for FY19. Just to be quick, I realise you've got a very busy morning. Just on page 22 and 23, just to show you guys what we've done over the last 6 months. Portfolio positioning. Whilst we did participate in the BHP buyback, we also bought those shares back. We basically took the franking credits from that trade and deployed that in a special dividend. We've bought those shares back, and as I said, we've also already got $2 million of specials from BHP again in January. We added to Woodside, Transurban, CBA, Ramsay, Woolworths, AGL, APA, Regis and Macquarie, top 10 there. The others are listed on the screen. And then on page 23, new positions, Coles obviously out of Wesfarmers, but we added Platinum and Magellan also to try and participate in the international fund space there. Added Stockland Group during November on a bit of a correction, and also come distribution, and added Pact Group to the portfolio. Whilst we got rid of Flight Centre, IWF and Perpetual. Pretty good portfolio. You'll see Coles there now in the top 25, and Wesfarmers and Woolworths weightings are about the same.